A down payment is one of the first things to think about when buying a home. Understanding how much you need and how it affects your loan is an important first step in your home buying journey. A down payment is the amount of money you pay upfront when purchasing a house. It is a portion of the cost of the home that you contribute directly, while the remaining amount is covered by the mortgage loan. The size of your down payment matters because it changes the total amount you have to borrow. A larger upfront payment usually means smaller loan payments each month, and it can sometimes even help you qualify for lower interest rates. Most lenders look for a down payment between 3% and 20% of the price of the home. The exact amount depends on the type of mortgage and your financial situation. When you choose a smaller down payment, you borrow more money from the lender. This leads to a higher loan balance and can result in larger monthly payments. A larger down payment means you put more money up front. This reduces the total loan amount, lowers your monthly payments, and can sometimes give you access to better interest rates. If your down payment is less than 20% of the home's price, most lenders will require you to pay private mortgage insurance. This protects the lender in case you are unable to repay the loan. The right down payment amount depends on your budget, your financial goals, and the type of loan available to you. Striking a balance between what you can afford upfront and what will save you money over time is key to making a smart decision.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.